This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, a look ahead to the August jobs report, what it could mean for Fed policy moving forward. I'm Tom Busby in New York.
I'm Caroline Hepker here in London, where we're thinking about the future of Europe's banking industry.
I'm Doug Krisner, looking at the power of the rally in Chinese tech shares and how much steam is left.
That's all straight ahead on Bloomberg Daybreak Weekend. On Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 92.9 Boston, DAB Digital Radio London, Sirius XM 121, and around the world on BloombergRadio.com and the Bloomberg Business app.
Good day to you. I'm Tom Busby. We begin today's program with the August jobs report. Non-farm payroll numbers out this Friday, 8:30 a.m. Wall Street time. And with another read showing inflation stubbornly high, what could a further possible slowdown in the U.S. labor market mean for the hopes of a Fed rate cut at its next meeting? For more, we're joined by Michael McKee, Bloomberg International Economics and Policy Correspondent. Michael, thanks for being here. Just this past week, we got that July PCE, another confirmation, inflation not going away. Let's talk about that report, what it means to the Fed, and how important this Friday's August jobs report is going to be.
Well, let's start with the PCE and say that it is important but not definitive for the Fed. It does show that inflation is not going down, and on a year-over-year basis, the core rate actually rose to 2.9% from 2.8%, which is going in the wrong direction if your target is 2%. On the other hand, the month-over-month figures did not show any deterioration, so it really is kind of pick your story here, and we know that those who think that we should be cutting rates in September have stuck to that story, and this wouldn't deter them in any way. The rest of the Fed is open to the idea of a rate cut. In fact, Jay Powell basically opened the door to it at his speech in Jackson Hole. And so they're waiting on data yet to come. And that'll be the jobs report this Friday and the CPI report that comes on September 11th. And the question is, do we see a significant weakening in the unemployment rate? Does it go up? I guess whether you call that strengthening or weakening, does it go up? And do we see a continued weak hiring? The kind of hiring that we saw in the July report and the revisions to May and June.
Well, there may also be seasonal reasons for if we see a big jump or a big decline in August, right?
Well, yes, you get into the school year beginning, and ever since COVID, we've had some trouble with adjustments for that. Also, in many states have changed their school year beginning times. And a lot of this doesn't have to do with teachers. It has to do with the supplementary workers at the schools, the janitors, the cooks, everybody else. So we may have that issue, but economists and the Fed will look through that and see what's been happening, especially with private sector jobs, and see if we see the same kind of decline. The forecast at the moment is for 75,000 jobs to be created, which is not that different from last month, but we may see that change during the week as we get more data, because this is the first week of the month, and it's the week where we get tons of data.
Yeah. And how about the unemployment rate? Could we see that go a little higher?
We could see that go a little bit higher. Right now, we're waiting to see what happens with the unemployment rate, because the forecast is for it to rise just a little bit to 4.3% from 4.2%. Okay. That is not unacceptable to the Fed. They have expected it to rise. Their forecast is for it to maybe hit 4.5%, but it's a speed at which it moves. So if it's higher than 4.3%, then you're going to have some concern expressed down at 20th and C Street in Washington.
Then, yeah, from 4.2 to 4.4 if it went. Now, so we have the CPI coming out. We have the jobs number coming out. But last week, we got some very encouraging news. We got 3.3%, although it's a preliminary reading on GDP, which is growing. Also, consumer spending and consumer incomes. Good news there as well, right?
better good news in the incomes and spending number. The GDP number is for the second quarter, and that ended at the end of June. So now we're 2 months into the third quarter. So it doesn't tell you all that much. The one bit of good news was that we saw more business investment. Don't have a lot of explanation for that because companies have been telling the Fed and telling us that they're sitting on the sidelines. But they did increase business investment, which is probably a reflection of what's been going on in the AI space. Now, the income and spending numbers were pretty good. Income maybe a little less than meets the eye in that it went up, but it's mostly automobile spending on the goods side. So the auto companies have said they're going to raise prices when they get to the new model year. So that may be something that has pulled forward some spending. The income numbers were better in that they rose, but if you look under the hood, the wages and salaries component went up 0.6% after just a 0.1 rise the month before. So Americans still have money coming in. It's a question of whether they want to keep spending it or not.
And so far they're spending it.
So far they're spending it. But we also had another number that came in that was interesting, and that was the trade deficit. We saw a big rise in imports again in July, as we did in the first quarter in January and February of this year ahead of the president's tariff announcement, and now maybe ahead of the tariffs. Yep. That's what we also saw. So companies trying to stock up on lower priced goods to sell them as long as they can before they have to raise prices. That may be also something that factors into the Fed's decision if they think that definitely inflation is going to rise significantly in the months to come.
Now, you are just back this past week from Jackson Hole, the symposium. You spoke to a lot of Fed officials. Great sound. Some of them are insisting that the extra consumer costs from the Trump tariffs are just a one-time bump. And that, yes, it's inflationary. Yes, it's a lot of pressure, but it's going to go away. A lot of others don't see it that way at all. How do you feel about that?
Well, historically, tariffs have been a one-time bump, but historically they've also been applied in a different way. Congress passes a tariff increase and sets a date, and it goes into effect, and prices go up on that date. With Donald Trump, it's been a whole bunch of different tariffs on different dates. Sometimes they're raised, sometimes they're lowered, and the application dates vary. So there's two things at work here. One is the idea that this is going to go on for a while because he's talked about imposing more tariffs on pharmaceuticals and on semiconductors and things like that. So we could see a rolling increase in tariffs. And that would perhaps feed into inflationary psychology that would raise people's inflation expectations. And that's what the Fed doesn't want to see happen. So you have Christopher Waller and Mickey Bowman saying, one-time increase, and we don't have to worry about it. Other Fed officials saying, yes, but it could feed into this other dynamic that we would have to worry about.
Well, a lot of inflationary pressures. We get the CPI in a couple of weeks. The August jobs report out this Friday ahead of Wall Street's opening bell. Our thanks to Michael McKee, Bloomberg International Economics and Policy Correspondent. We move now to earnings from the cloud-based software company and Dow Jones Industrial Average component, Salesforce, coming out after Wall Street's closing bell on Wednesday. How has the explosive boom in AI at other software companies impacted Salesforce's growth? For more, we're joined by Anurag Rana, Bloomberg Intelligence Technology Analyst. Now, Anurag, thank you so much for being here. Salesforce investors have not had a lot to cheer about. Shares are down about 25% so far this year. As other software companies have invested a lot more in AI, what are you looking to see in its second quarter results?
So, Tom, when you look at a company like Salesforce, it is very different than, NVIDIA or CoreWeave or Oracle, frankly, because it's on the application side of software. And in this area, we are still not seeing that level of implementation of AI, because even though, for example, Salesforce has some really good products that can help out with their AI journey, the macro spending on technology is still weak, which is companies are not spending at that same level as they were on non-AI tech spending, which is having an impact on the order book of Salesforce. And that has been the story for the last, let's say, 12 to 18 months. And we think a little bit of that will come back again when they report next week.
So what do you think they will say then about growth and demand trends if maybe they're a little behind in the AI spending and the AI products. They do have Agentforce and Data Cloud, but what do you think they're going to tell investors?
No, you're right. I mean, they will talk about those two products quite aggressively and how the adoption rate is very strong. And we absolutely believe that both Data Cloud and Agentforce will do well. But again, as a percentage of the entire company, it's a very small portion of total sales. On the other side of the equation, we do anticipate them talking about, tougher business conditions and elongation of cycles in order to complete orders. And I think that's where, those comments would be looking for. There is a particular metric called remaining performance obligations or current remaining performance obligation. And that's an area where it gives us an idea about the growth rate of the orders. They have guided down that number to go down from 11% to 9% in this quarter. Based on the results we saw from Workday, we think they should be able to do better than that. But again, till we get this hangover of tariffs and economic uncertainty out of the way, we don't see that number accelerating, and perhaps that can only happen next year at this point.
Now, do you see that as more of a broader pullback in spending on IT, or is it your companies are just spending on other products from other companies?
No. This is absolutely broader. This is not just Salesforce specific. We say the same thing for Workday. We are seeing the same aspect for consulting companies, whether it's IBM Consulting or Accenture for that matter. So this is a broad-based phenomena where companies are being measured in the way they are spending on technology. And for right now, they're spending more on AI-related products or AI-related infrastructure, which is, AI servers and chips and models and trying to set things up. That's where a lot of the spending is going at this point.
And what we saw just this past week in NVIDIA's latest earnings, I mean, what does that tell you about AI spending and AI infrastructure spending? Is there a possibility of a slowdown in demand in the future, or is this maybe just a blip?
Well, things are looking good for almost the entire ecosystem, and with NVIDIA, obviously, there's a case of elevated expectations in what they did. I mean, I think the results were pretty good, but when you look at it, Oracle will report over the next couple of weeks. We think they're going to go and talk about a similar increase in order book for them from companies like OpenAI trying to get more of their cloud infrastructure to train their models. So we do anticipate a good season for companies that are more on the software infrastructure side. I think it's going to be tougher to see what happens on the application side.
Well, a lot of growth, a lot of changes. Salesforce Q2 earnings after the closing bell this coming Wednesday. Our thanks to Anurag Rana, Bloomberg Intelligence technology analyst. And coming up on Bloomberg Daybreak Weekend, we hear about the future of Europe's banking industry. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Coming up on Bloomberg Daybreak Weekend, China steps up its technology rivalry against the U.S. But first, in the coming days, the banking industry gathers in Germany for a couple of major banking conferences. European banks have seen their share prices on a tear in recent months, but there are tests ahead from U.S. tariffs, political instability, and the extent of interest rate cuts. How will insiders navigate the landscape? For more, let's go to London and bring in Bloomberg Daybreak Europe anchor Caroline Hepker.
Tom, European banks on the STOXX 600 Banks Index have surged since 2022 to a 17-year high versus the lows of late 2022. But there are risks gathering for the second half of this year. Deutsche Bank and Commerzbank, top performers on the index, have recently been downgraded by Goldman Sachs analysts. The outlook for the industry is something Deutsche Bank's CEO, Christian Sewing, discussed recently on Bloomberg Television. He says there is still a big opportunity for his firm and for others.
Well, I do think what we see in this world is with all the geopolitical uncertainties, with all the also economic uncertainties, there is one trend which is the same across the world. that our clients want to have a European alternative to the US banks. We have very strong US banks, very capable US banks, but in this world of geopolitical uncertainties, they want to have a capable global European player. And there are not so many European banks left with a full investment bank, with a full corporate bank, with a global network in over 60 countries. That's the role we can play. Now, this role we not only want to play because we feel ourselves as a global bank, but it's obviously much easier to do that if you are coming from a country which is economically increasing, which is economically on the right path, and which is also pulling now Europe. And therefore, I think we have a unique chance, not only as Germany and Europe, but also as Deutsche Bank, to actually be the one who is facilitating and who is contributing to our clients' growth around the world. The diversification also in banking, not only to rely on one bank, but on many banks, and that from a regional perspective has never been bigger than now.
And you touched about diversifying, and just another question to you. Is this buy Europe trend, is this a lasting thing? Is this something that you're seeing from investors that you talk to, that they are wanting to make a meaningful commitment to Europe? And what does that actually look like in terms of numbers from where you're sitting?
Well, for the first time, we see, obviously, since the last 3 or 4 months, a quite significant reallocation from funds, in particular into Europe. The interest is huge. Whenever we talk with investors, they really want to understand what's going on in Germany, what's going on in Europe. By the way, already in Davos this year, 6 months ago, most of the investors said, micro, Germany is really good. And with that, they mean the German corporates, the German companies. Macro, you need to do improvements. And that's exactly what we want to try now. Of course, the government stepped up with the fiscal program, but also with the reforms. If we now actually do something, so to say, together, if we march in parallel, we have a huge chance. And then I do believe, with further reforms to come, and that is necessary, I do believe that this trend of reallocating funds to Europe will not stop. If we are not doing further reforms and just rely on fiscal debt, that doesn't help. We need the fiscal reforms.
Yeah. That was Deutsche Bank CEO Christian Sewing speaking there. So in the coming days, academics, professionals and leaders from the worlds of banking and fintech will convene in Germany to discuss topics ranging from preparing for geopolitical uncertainty to optimising productivity through AI. But just how uncertain is the path ahead? Joining me now to discuss is Bloomberg's EU finance reporter Nicholas Comfort and Stephen Aarons, our team leader for EU finance. Welcome to both of you. Nick, can I start with you? Feels like back to school, back to conference season, doesn't it? What do you think it's going to be on the minds of these bankers and academics and the industry as we get into conference season?
In short, I'd say D&D, deregulation and deals. Those are the two big things that the bankers will be focusing on. Deregulation is something that affects all of the banks. Regulators like to call it simplification rather than deregulation, but what the bankers are really after is either a wholesale shredding of certain rules or a tweaking of them in order to free up some capital here and there, which they argue they can put to better use, for example, to lending for whether it's renewable energy or defense or technology, whichever your pick is. And then on the deals front too, it affects more individual banks, but everyone's interested in what's happening around BNP Paribas and UniCredit, especially. That's what's on people's minds at the moment.
Stephen, why has Europe's financial services sector done so well over the past 4 years? I mean, if you look at those leading bank stocks, they're absolutely stellar performance.
Absolutely. I mean, the performance of banking stocks for the past 4 years, and especially since the beginning of this year, has been absolutely stunning. And the reason for that's been the extremely dismal performance of banking stocks in previous years. As you may remember, there was an era of negative interest rates in Europe for a long time, set by the European Central Bank, and that caused a decline of profitability in many European banks. That was reversed in 2022, and since then, European banking stocks have been on a tear, boosted since the beginning of the year by, especially in Germany, for Deutsche Bank and Commerzbank, by the prospect of stepped up spending, public spending on defense and infrastructure. So that's kicking in now, and that is probably the broad explanation for this extremely good performance.
Yeah. Okay. So, Nicholas, what then are the biggest risks going forwards? Because things don't look quite so bright, maybe, for the second half of this year. Is it the risks of rates not coming down much further? Is it about Fed independence, or the hit to economic growth in Europe, maybe, that's going to come from US tariffs?
I'd say definitely tariffs. That's the main thing. If you're a chief risk officer at a European bank at the moment, that's the number one thing you've got on your mind. In terms of what does it mean for my corporate lending portfolio, the companies I lend to, are they going to be in trouble? Are they just going to are they going to see losses on these loans because they see a large chunk of their revenue dissipated? But also, I mean, you can see the positive there as well. I mean, if these companies are going to be investing in the United States, for example, to build new factories, then that's where the chief risk officer's colleagues over in commercial banking would be jumping in and trying to give them more loans. But yes, tariffs is the number one thing which they probably have on their mind.
Stephen, we heard from Christian Saving earlier there saying that Europe's banks will fare well because investors could potentially flee US turbulence. Is that true, given recent political developments in Europe and especially in France?
It seems to have been true, at least. So we did see a strong flow of institutional investment out of the US into Europe during the first half of the year, especially after the US administration unveiled the tariffs plan in April. That is now probably something that people will look at. You're right, there is political instability, especially in France. There's also political instability in the Netherlands, a small economy, but still an important one. And so Europe isn't sort of in the clear. It's too early to say, but yes, I would imagine that people will look at this again. So far, we don't have any indications that flow from the US to Europe has reversed. It's still going on, apparently.
Nicholas, look, the nice glowing tans that people have acquired maybe over the summer holidays might be starting to fade in September, but the French Prime Minister reportedly didn't take a holiday. How prominently do you expect the issue of political instability in Europe to be on the agenda as you see it?
Yeah, I mean, I saw an interesting analyst note the other day saying sort of that this is, I mean, it's kind of the norm. We've gotten used to it at this stage. I mean, so in terms of immediate impact on banks from let's say their holdings of French sovereign bonds, I don't think that's something which is going to be eroding capital levels too much, for example. But yeah, I mean, maybe more in the longer term. If you're a bank catering to companies in France, then these companies are worried, and these companies aren't necessarily going to be making investment decisions, and that they're not going to be borrowing, they're not going to be doing M&A transactions, and so that's really maybe a threat also to the revenue that banks exposed to France stand to make. But I mean, in terms of real big sort of hard-hitting financial impact on capital, on their financial strength, I'd be less concerned.
So, Nick, in terms of M&A, are we going to see more meaningful consolidation? Seems to always be a kind of waiting game in Europe to see big consolidation cross-border.
Yes, definitely. So, I mean, deals in Europe take a long time, and they have been, I mean, cross-border deals certainly have been few and far between. I think the experiences of UniCredit shows that you have to be persistent, and you have to also have maybe multiple options ahead of you if you want to be doing deals. With UniCredit and Commerzbank, for example, that seems to be a waiting game over for Andrea Orcel, the CEO. It could be that we see something happen on that in the months or year ahead, but it's a lot of the stuff which would really support those cross-border transactions that you mentioned. A lot of the architecture is missing, but then maybe bankers have been complaining about that for a long time, so they need to jump over their shadow, as you'd say in German, and just and crack on with it if they really want to pursue that growth.
Oh, I don't know what the translation of that phrase is into an English idiom. Interesting. Stephen, in terms of the impact, though, of the political pressure in the US that we're seeing on the Federal Reserve, on the central bank, I mean, is there going to be any banker that's not thinking about that? Or is it more about the Trump administration's deregulation drive in the US? Is that what the European banking sector will be thinking about?
I think it's a mix of both. The Fed is certainly the current development that will dominate talks for as long as it's going on, whatever happens at the Fed and how that impacts the interest rates set by the Fed in the US has global ramifications, especially on banks and especially on Europe. And so everyone will be watching very, very carefully without really having any precedent to judge what this could lead to. And so it will dominate conversations, but everyone will just agree in Europe that there's little they can do and they're just bystanders. On deregulation, it's something that's been going on. We haven't really seen very tangible results in the US yet, but there is sort of a move to soften a package known as Basel, which is really important for banks globally. The EU banks have been taking a cue from that and have been putting pressure on regulators here in Europe to take a similar approach, because they say if the US does deregulation that's not replicated in the EU, that would put them at a competitive disadvantage. So they're actually happy about the deregulation drive in the US because it gives them a reason to say we want the same in Europe.
So lots for Europe's bankers to be discussing in the next few days. Well, my thanks to Bloomberg's EU finance reporter Nicholas Comfort and to Stephen Aarons, who leads our team covering EU finance based in Frankfurt, for joining me. I'm Caroline Hepker here in London. You can catch us every weekday morning for Bloomberg Daybreak Europe beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. Tom.
Thanks, Caroline. And coming up on Bloomberg Daybreak Weekend, China steps up its technology rivalry against the U.S. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. A new China buys China narrative taking shape as Beijing steps up its tech rivalry with the U.S. Chinese tech indices have seen a boom that runs contrary to concerns about the world's second largest economy. For more, let's get to the host of the Daybreak Asia podcast, Doug Krisner.
Tom, China's main stock markets have been soaring in the month of August, especially where tech shares are concerned. The tech-heavy Chinex index outperformed the S&P 500 by a mile, thanks to a rally in Chinese artificial intelligence stocks. Key question here, how much more can we expect? Well, that's a good question for my guest, Bloomberg opinion columnist Shuli Ren, who joins us from Hong Kong. Shuli, thank you so much. It's always a pleasure. I think because of your expertise in markets, we can agree that attempting to predict the direction of any market is extraordinarily difficult. One of the things that you point out, though, in your piece is that a parallel might be useful here. Help me understand that.
So people are looking at 2025 versus 2015. If we recall, 2015 was a crazy year for China's stock market. In the first half, there was a euphoric rally, like with the benchmark index up 50%, and in the second half, all that 50% gain was given away. And then the Chinese government had to scramble to bring in the national team to support the stock market. So people think that 2025 has very similar economic drawback as 2015, because just like a decade ago, the economy is in a deflation. We have almost 3 years of producers' deflation, which does not bode well for corporate profits, right? And 2015, we were seeing the similar things. So the question is, how can the stock market be doing so well when the economy is so bad? And a lot of people have pointed out that this is a liquidity-driven rally, just like 2015. But I have to say it's a little bit more than that.
One of the things that I think is very interesting is that the mainland Chinese markets really have a great deal of retail participation. And in many cases, these investors have felt the pain of the Chinese housing market, have they not? And I'm curious to know whether or not they're particularly susceptible if there's a kind of a pullback here and they may be bit one more time.
Well, the Chinese government certainly wants a slow a slow running bull market, kind of like what you see in the S&P 500, 10-20% rise every year, which is quite nice, right? But that's not what's going to happen with China. Like what you said, China stock market has heavy retail participation, so it can never be a slow bull. What you will always see is basically mad bull. Basically, like you can see big rallies in individual stocks, 20-30% per day.
So what about the DeepSeek moment? We talk a lot about that. We talk a little bit about the artificial intelligence wave that is cresting in China, but it's kind of interesting because some of that has been powered by advanced semiconductors, some of which have been manufactured by NVIDIA, and I'm thinking of the H20 AI chip, which is tailor-made for the Chinese market. But recently, Beijing seemed to change its tune when it comes to the H20, and I'm wondering whether that could be maybe a catalyst for some difficulty in AI stocks in China.
It absolutely is a catalyst. The interesting thing about China's DeepSeek moment is that earlier in the year, we found out DeepSeek was quite good at making large language models, right? And interestingly enough, the biggest beneficiary is not mainland China's stock market, but Hong Kong stock market, because the Hong Kong stock market has the biggest consumer tech companies. For instance, Alibaba, Tencent, Baidu, right? All these consumer tech companies, they were basically piggybacking on the DeepSeek's reasoning models and coming up with their big generative AI models of their own. So basically, investors thought, oh, okay, China's consumer tech companies are going to become like US Microsoft or Meta, right? And then what you saw was that in the first half of the year, the Hong Kong market had a big run, whereas the mainland China market was not doing much. But now the story has flipped a little bit in that it seems quite clear that the Chinese government not only wants to have big AI models, but also to power them with their own chips, right? And then the chip companies happen to be listed in Shanghai and Shenzhen, not in Hong Kong. That's why we are seeing a big run in the mainland stocks.
So you said a moment ago that China is once again entering a liquidity-driven bubble. Where is this liquidity coming from? Is this all due to PBOC policy?
No, this time is quite different. So since COVID, like the Chinese people have been saving a lot. A lot of it is, well, it started with the lockdowns, right? You had nowhere to go, so you basically save a lot of your income. And then the housing market didn't do well, and people got even more cautious. And now the term, a popular term in China is that don't charge me IQ tax. People are very cautious on what they want to spend, and they want value for money. And that means that they're saving a lot more, right? And how much of that money is going to go? In the last couple of years, they basically put that money into the bank deposit. But the bank deposit rates are getting lower and lower. And if you have a catalyst, all that money that's earning like 1 or 2% in the bank deposits, they can come into the stock market.
So you mentioned kind of low interest rates there. That takes me to the notion of margin and whether or not retail investors are using margin as a way to try to create a bit of leverage in the equity market.
I think retail investors everywhere in the world like to use margins if they can to get a little bit to juice up the returns.
Mm-hmm. Is that happening right now on the mainland to a great degree?
Yes, but they're not as crazy as before. It's true that the margin transactions is at the highest level since 2015, but the stock market is also 50% bigger. I just want to quote some statistics. The margin transaction is about 10% of daily trading volume. In 2015, at the craziest time, it was 30%. So it's getting crazy, but not so crazy.
Do you think the government's concerned about everything that we're talking about here and the potential damage that, let's say, the bursting of a bubble may bring about?
Oh, absolutely, because 2015, President Xi had to do a lot to calm down that stock crash, right? Like the government was definitely scrambling, and that they don't want this kind of crazy mad bull market again. So they are getting concerned, and that there are market rumors that the government is cracking down on margin lending.
So that's a very interesting point, and I'm curious about the way that the government may work through the various brokerages in China. Do they carry kind of a heavy hand here in telling what brokers to do?
There's this thing called the window guidance. They don't officially post the notice saying, oh, you cannot have more than, say, 50% leverage or whatever. But they will tell their brokers not to give out those margin loans so much. So the brokers, they get it, right? Like they get that they will go into trouble. So they will try to rein in margin trading. Having said that, lending is good business for them as well. So they have to play a pretty delicate balancing act.
We'll leave it there with that delicate balancing act. Shuli, thank you so very much for joining us. Bloomberg opinion columnist Shuli Ren on the line from Hong Kong. So let's stay with the tech story in Asia. We caught up with Carey Craig, global market strategist at JP Morgan Asset Management. He spoke to our TV colleagues Paul Allen and Avril Hong on the Asia trade.
We're seeing Asia stocks, they seem to be running a bit higher at the moment. We have the tariff backdrop as well. India facing double the rate. South Korea came away with the meeting in the US from a positive tone, deals bonanza. I think we're hearing about some of these Korean companies and their expansion plans in the US as well. How are you playing South Korea, particularly related to Taiwan? Do you see outperformance there potentially?
Yeah, I think we're still quite favourable on North Asian markets more broadly, whether it's China, Taiwan and Korea. I mean, they have done very well this year in terms of their performance, so I think that's something to bear in mind. And valuations have moved up a little bit. I think the tech cycle still has more to go, and the carve-outs we've seen around some of the semiconductors being put into those deals, the offshore investment that will go into the US from some of these companies being something that will support that market. And I think secularly that AI theme is still very prominent, so we would argue that those are going to be the beneficiaries of it. Whether it's China or Korea, I think you're really coming down to a couple of companies that are driving that decision. So it's really more of a bottom-up view in terms of which of those companies you think are better positioned in this environment, rather than thinking about those countries. So I think it's a couple of stocks that really driving the decision between South Korea and Taiwan in terms of relative performance, not necessarily just thinking about the country there.
Yeah, in terms of tech in China, we've seen a pretty strong run up there, and in fact a pretty strong rally in general when it comes to Chinese equities. How's that looking to you? Do you feel there's a risk of a correction here? Does the fundamentals stack up?
Yeah, the fundamentals do look quite good to us. Obviously, there was the valuation argument from earlier in the year, and Chinese equities still look relatively well priced compared to many developed market peers. There's some appealing characteristics to the onshore market in China, given the lower correlation they have to the US equity, so building in a bit of a diversification in a portfolio. But fundamentally, again, thinking about that tech theme, Chinese tech is a way to play it that's not related to the US and some of the risks that come with that. And we do see that as being more prevalent. It is a little bit disconnected from what we're seeing in the economy as well, given the softness in some of the economic data and only the slow movement in fiscal support coming through from the Chinese government. So I think there's still room to go into China. I think it becomes quite an active position given the outlook for the economy. And again, we're seeing that bit of a split between what we're seeing in the offshore and the onshore market, where it's really the offshore market where you're seeing a lot of these tech themes being more prominent, whereas the onshore market seems to be a little bit more about dividend and income, some of the performance in the financials. So I think there's very much different ways to play China depending on what you're looking for in terms of growth versus income at the moment. But it is a market that we do continue to like in terms of where we can find value around the world and looking for continued performance.
Where are you seeing risk at the moment, and how are you hedging against that?
I mean, I think there's a way of framing how investors are feeling, and that's a little bit of sort of uncomfortably tolerant of what's out there at the moment. Obviously, markets have run pretty hard since we've seen that sell-off in April. There are concerns around some of the softer economic data that's coming out, obviously the political risk that's still in there. But, fundamentally, we do see a global economy that's improving, and that should support the outlook for both equities in terms of risk and nominal growth. But also, it's not huge growth. It is sub-trend growth around the world. And so we do think about duration in terms of a hedge against that growth shock in a portfolio, but also barbelling that with a little bit more of the credit space in terms of high yield, given the carry that you're getting on that, and rather than owning outright duration. The other hedges against that inflation, I think that for us really does default to things like alternatives and real assets, where you're getting that less sensitivity to the economy, the good outcome, and obviously some inbuilt inflation protection as well. So we need to think about a broader diversification of assets within a portfolio to really counteract all the risks that are out there in the global economy.
That's Carey Craig. He is global market strategist at JP Morgan Asset Management, speaking with Bloomberg TV host Paul Allen and Avril Hong. And I'm Doug Krisner. You can catch us weekdays for the Daybreak Asia podcast. It's available wherever you get your podcast. Tom?
Thank you, Doug. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.